At the opening of the American session, the U.S. stock market trades cautiously amid concerns about the debt ceiling and banking woes. With the earnings season over, the stock market struggles to find new drivers. In addition, U.S. inflation is due this week. InstaForex presents to you a fresh wrap-up of the U.S. trade. On a Friday, U.S. stock indexes soared on Apple's upbeat earnings report. By the close of the session, the Dow Jones gained 1.65%, showing the best performance since January. The Nasdaq added 2.25% and the S&P 500 advanced by 4.85%. In the course of a pre-market trading on a Monday, the indexes were mainly in the green zone, up by 0.2 and 0.3%. Except for the Nasdaq, it repeatedly hovered between the red zone and the green zone. Speaking of the daily outlook for the S&P, it will likely be trading in the range of 4,080 and 4,190 points. Apple's positive earnings results instilled optimism in Wall Street and became the main driving force for the entire stock market on Friday. The giant reported that its iPhone sales grew by 1.5% to $51.3 billion, beating expectations of a 3.3% fall. Global smartphone shipments fell by 13% in the first quarter. iPhone's share price rose by 4.7%, the highest in about 9 months. Shares of regional banks recovered following the recent fall after some lenders saw their ratings revised upward. Thus, PacWest grew by 81.7%, Western Alliance added 49.2%, and the regional bank index increased by 4.7%. Likewise, oil quotes soared on Friday. By the close of the session, all 11 S&P sectors showed growth. All in all, the Dow and the S&P 500 closed the week with a loss, and the Nasdaq edged slightly higher. According to Refinitiv, the predicted decline in the S&P earnings in the first quarter has improved since the beginning of the reporting session and is now just 0.7% year-on-year. At the same time, if we shift focus to the macroeconomic calendar, we will see that the stock market faced some pressure on a Friday. The U.S. Department of Labor report showed an increase in the non-farm payrolls in April and surge in the average hourly earnings, which indicated that a strong and resilient labor market could give the Fed more opportunities for tightening. The economy remains stable, which means a change in the interest rate stance is highly unlikely. By the way, Jerome Powell recently noted that it was too early to talk about the end of the cycle of rate hikes due to high inflation. With inflation data due on a Wednesday, investors are likely to trade cautiously already at the start of the trading week. U.S. stock futures were subdued on Monday as the shares of regional and large U.S. banks kept recovering. However, the situation may change intraday. Apparently, consumers' trust in the resilience of the U.S. financial system has been seriously undermined. So, Monday's opinion survey of the Federal Reserve's senior loan officers is likely to attract more attention than usual. The survey includes up to 80 large U.S. banks and 24 U.S. bank branches worldwide. It's supposed to show how lenders themselves see the change in the lending conditions in the first quarter of the year. Goldman Sachs expects to see 60.2% of respondents reporting tighter lending conditions. The bank says that this level is tighter than the dot-com crisis but less extreme than during the financial crisis of the height of the pandemic. Ahead of the survey publication, stocks of regional banks continued to rise. Thus, PacWest shares jumped by 2.5% after announcing quarter dividend payments. Western Alliance, Comerica and Zions gained between 2.8% and 8.9%. The shares of such major banks as Goldman Sachs and the JP Morgan appreciated in the range between 0.8% and 1.2%. Apart from the banking sector, investors are monitoring the situation around the U.S. government debt. U.S. Secretary of Treasury Janet Yellen warned on Sunday that a failure to address the issue of the debt ceiling could trigger a constitutional crisis, and even more than that. The last time when such debates took place, back in 2011, it cost America its perfect AAA credit rating. According to Yellen, if this situation repeats itself, it would call into question the federal government's creditworthiness. Scope Ratings, one of the leading European credit rating agencies, on a Friday placed the United States AA long-term issuer and debt ratings under review for a possible downgrade. And this is the final week for the U.S. policymakers to come to an agreement. Last week, Joe Biden, who meets congressional leaders on a Tuesday, criticized Republicans for their refusal to vote for a higher federal debt ceiling, signaling that there might be no compromise at the meeting on May 9th. Stalemate on Washington over raising the U.S. debt ceiling raises the risk of a new market turmoil. Most analysts believe that there will be a solution to this crisis. Yet, according to S&P Global Market Intelligence, the cost of insuring against the risk of a U.S. sovereign default has surged to its highest level since 2011. And this week, markets will also pay attention to the U.S. inflation data that is due to be out on Wednesday. Traders will also focus on producer price data, weekly jobless claims and consumer sentiment, therefore, unless banking surveys or lawmakers bring more surprises, Wall Street could stay subdued on Monday. In the foreign exchange market, the US dollar index was trading moderately lower. On the intraday chart, USDX fell by 0.2% and settled around the level of 101.10. The index is projected to stay in the range between 100.80 and 101.50 in the course of the session. The rise of the euro and the pound ahead of the Bank of England's meeting put pressure on the US dollar index. Despite some support from the robust labor market, the greenback is weighed down by overall uncertainty, including the situation around the debt ceiling. Besides constant banking jitters, arose fears of a larger, more serious collapse in the financial markets, which keeps traders alert. The S&P data may somehow prop up the US dollar, and the US Federal Reserve raised the rate by 25 basis points last week and hinted at a possible suspension of the tightening cycle. So the fresh inflation data may be the clue to how long the Fed is going to keep the rates at 5.25% before cutting them. Currently, investors think that the US rates have now reached the peak and could end this year below 4.40%. Against this backdrop, the US dollar is close to its lowest level in a year against the basket of major currencies. It's still too early to give up on the greenback, at least until a clear peak in the US rates is seen and the decision on the public debt is made. In the meantime, the overall environment for the US dollar will remain predominantly bearish. The Canadian dollar kept rising versus the US dollar. The USD CAD pair gained 0.38%, trading at 1.3323, and it's likely to remain in the range of 1.3270 and 1.3390. Whereas an increase on Wall Street was driven by a surge in Apple shares, the loonie advanced amid growing oil prices, and they jumped by 4% following an upbeat non-farm payrolls report. In the morning, oil continued its rally. Brent crude rose by 2.4% to $77.17 per barrel, while WTI crude increased by 2.7%. Brent crude ended last week with a drop of about 5.3%, and WTI crude fell by 7.1%, even after Friday's rebound. Both oil benchmarks have been declining for 3 consecutive weeks for the first time since November. However, the quotes rebounded as the oil market was oversold, and Brent managed to consolidate at the support level before reaching the March low. Goldman Sachs analysts said that concerns over supply and demand in the short term were exaggerated. Saudi Arabia and other OPEC members announced voluntary oil production cuts in May, and the next OPEC meeting will be held on June 4. The OPEC report will be published on Thursday. It will provide fresh data on supply and demand. The sentiment in the crypto market is rather grim today. Digital assets lost more than 3.5%. Closer to the opening of the American session, Bitcoin settled at $27,900. Top altcoins were mainly in the red zone. Ethereum, Solana, Ripple, Binance and Litecoin dropped roughly by 1% to 4.6%. Binance, the world's largest cryptocurrency exchange, posted Bitcoin withdrawals twice within 12 hours, citing heavy volumes and a surge in processing fees. Our said fees did not anticipate the recent surge in Bitcoin network gas fees, Binance said in a tweet. We are replacing the pending Bitcoin withdrawal transactions with the higher fees so that they get picked up by mining pools. According to CoinMarketCap, Binance trading volume amounted to more than $7.6 billion in 24 hours, more than 8 times the next largest venue, Coinbase. CryptoQuant and analysts believe that over the weekend, Binance moved about $4.4 billion worth of Bitcoin across its digital asset wallets in 2 tranches of 117,000 and 40,000. Binance said that Bitcoin was moved between Binance hot and cold wallets due to the BTC address adjustments. Apart from a sharp decline in digital assets, shares of crypto companies fell too. Coinbase stock shed 4%, and the Bitfarms shares decreased by 4.3%. Bitcoin may approach the support level of $27,600. If it declines below this level, it's likely to test a low of $27,200, and if Bitcoin consolidates at $27,900, it has a chance to recover to $28,600. These are the main highlights of the American session. Subscribe to our channel and keep close tabs on the market developments with us. See you soon!